Hey everybody, we're with Kevin today from the Macro Tourist. So we want to take you on a little tour of Macro. I've always wanted to talk to Kevin. I've been following his work for a long time. Even when your product was free back then, and then you
Oh,
switched to a paid product. So
right.
it's been a super interesting thing to follow, especially if you're a macro trader. Just getting to understand like what's going on in the macro world. Like I think there isn't a lot of people who really communicate it much better than Kevin. So Kevin, how did you get into macro? Because I think it's always interesting to kind of start there, because
Okay.
you'll hear people have different stories that happen in their lives. So how did you get into macro?
So, Jason, first of all, thank you for the kind words and thank you for all your support with the letter. How did I get into macro? Well, I grew up and I was actually, my father was the research director for a brokerage firm up here in Canada. And so I grew up with a lot of chatter about stocks at the dinner table. So something that I was just kind of exposed to my whole life. I also just loved games. Like from the time I was little, I wanted to play like board games. Like when I turned into like old enough to actually start to gamble. I started to try to figure out systems for like horses and like you name it. I had all these kind of schemes going on and stuff like that. And along the way, I stumbled upon Jack Schwager's book, Market Wizards. And I read this and I was like, that's what I want to do. Like that was it was all from that book. And I've had the good fortune to interview Jack. And I told him, I said, your book actually was the most crucial thing in terms of me deciding what I want to do. So I thought these guys lived the greatest lives in the world. And I still look at all those guys like Paul Tudor Jones, Stanley Druckenmiller, all those folks as kind of my heroes.
So you have a focus on bonds, the futures markets, commodities, and so on. So how did you get into that sort of thing? Because I think most people they start trading, they get really like you said, there's stocks around the table. You're hearing about this
Yeah.
name, this name. How do you then go from that to going, hey, I'm going to get into these crazy things called bonds and these other crazy things called commodities and so on?
Well, so everyone like often says to me, like, you're a bond guy, right? And I say, no, actually, I'm not. I'm actually an equity fellow. And along the way, before I started writing my letter, I actually worked at a bank. I worked at Royal Bank of Canada, and I was the equity derivatives trader. So I am like from an equity background. I am more so a derivatives trader. I was always kind of like numbers. I did program trading and things of that nature. So what happened was after I quit the bank and I just started to trade for myself, and I basically have been doing that ever since 2000. I've just, in essence, traded my own account and along the way written this letter. I just started to find new opportunities of things to trade. And one of the things that made me mad at the bank was I'd come up with a new idea, I'd put it on in my inventory, and then somebody from the bank would come and say, "You can't do that. You can't trade that." And I'd be like, "Oh, okay." And I'd get it off the sheets. And then I go find some other idea and they'd be like, "You can't trade that either." And I'd be like, "Well, what?" And like, so that was ultimately like my biggest frustration is that I found these ideas and I love coming up with new ideas and new trades. And so once I started trading for myself, I didn't have that encumbrance and I just traded whatever I wanted. And over the years, people said, you've been trading your own account a long time. How, like, what do you specialize in? How have you gone about being able to make money in this, like for this long? And I say, well, the reality is that I don't have a specialty. And that's why I kind of tongue in cheek called myself the macro tourist. And people kind of laugh and they say, that's like derogatory. And I go, yeah, I know. It's something that, and for those who don't know, it's basically what you call the people who wander into a trade, not really knowing what they're doing, and they're tourists and they kind of wander in and make a mess and then leave. And that's kind of ultimately how I've been. I've kind of gone and looked for opportunities. And when there was an opportunity in something, and one of the examples I like to give is in 2014 or something, when the oil market ran into the trouble the first time, not the time it went negative, but the first time, I got bullish on oil, and probably too early, but I got bullish and I started looking at it and I was like, looking at the futures market, and the trouble is the futures market was trading, with the forwards were trading way higher. So I was like, okay, well, that's going to cost a fortune. I got to be really right. I got to get that timing perfectly for that to work. So I went and looked at equity market, and the equity market was trading like, unfortunately, the stocks were down so far because of the oil problems that actually they were all trading like call options. And I was actually worried about it. It's like, oh, the moment that the oil picks up, these companies are going to have to issue a ton of equity because the reality is their balance sheets are such a mess. And then I went and looked at it and I said, oh, geez, like, what am I doing here? Let's go look at the corporate bonds. And so I started trading corporate energy bonds, like, because they were trading, 20, 30, 40 cents on the dollar. And the way I thought it through was I said, okay, if I'm wrong, this what's going to happen is they're going to recapitalize these things. My bonds will become the next round of equity, and I can live with that. That's what I'm happy with that. If I'm right, these bonds go from 20 to 80 or 100 cents on the dollar, and it ends up being a great trade. And ultimately what they're going to do is they're going to issue equity the moment it perks its head up, and they're going to go and buy back these bonds. So that was an example of 1 year when I ended up trading a lot of corporate credit. And up until that point, I had really not traded that much. And I was like, okay, well, I got to figure this out. So I just put my head down, started learning about it and trading it. And so throughout the years, I've kind of just expanded my knowledge about things that I like to trade. And it's kind of just been a great adventure. And although I do kind of recently, I've been talking a lot about bonds, it's not something that I solely, focus on. I do a lot of equities. I do a lot of other derivatives and things like that. And if I think there's an opportunity, I'm going to trade it.
No, I love that, and I think that's a true macro trader isn't, because people, same thing with me. I get, Jason, you're the commodities guy, and it's because you get known for a couple trades in something, and then everybody says you do that, and it's like, no, it's, for me, it's all the same. And I've always liked your writing style because you could go from one thing to another to another. And I think that's how it's really done well, because you really can't, I can't understand something like the bond market without looking at oil, seeing how energy's doing and so on.
Right.
And I think all those things are connected. So you're one of the few people out there that really writes it in that way and showing the connections there. So I really appreciate that. It helps me to put together my trade thesis, most of the time, because I can't just go directly into something without understanding the intermarket correlation.
For sure. And there's a million other examples like that. Like I remember I've become somewhat MMT kind of sympathetic, and I know everyone hates MMT and they're all like, throwing up in their mouth the moment you mention MMT. But the way that worked was I was interviewing someone, or actually no, I was on a show. I remember Jason Perks from Bespoke. He had me on the show, and earlier I had kind of heard about this MMT, and I was like, okay, what is it? I better learn about it. So I put my head down and I started learning about it. And then I looked at who knew a lot about it, and I phoned up, it's not Jason, it's George Perks. George Perks from Bespoke. I phoned up George and I said, listen, can you help me out? And he said, okay, great. This is what you do. Go watch this, this, and this, and this. So I started watching this. And at first it was like, I was like, this makes no sense. This is wrong. This is terrible. These guys are idiots. And I went about trying to prove they were wrong. Like, I was like, okay, if they're so wrong, I should be able to prove they're wrong. And I went about it, and it was actually more difficult. And I know a lot of people will say, I can prove this and that stuff like that. They're actually, the plumbing about how the economy works, a lot of it is actually really well thought out, and it actually works. But the point is that I was open to that idea, and it actually really helped in terms of understanding trades and setting them up. Like when we had a situation where COVID hit, I got bullish, and I kept saying, the government can fill the hole that is being created through this COVID if they go and they spend enough money. And everyone's like, no, it didn't work last time. I go, no, last time they just did monetary stimulus. They didn't do fiscal stimulus. And so by staying open to this idea, I didn't get bearish. And actually I was one of the few, good calls that I had was get really bullish on equities and risk in general into the COVID things, because I understood the way that this MMT could work. And ultimately it was MMT. But anyways, the point is that you need to be open to all these sorts of things and understand how all the different pieces work together. And to your point about macro, that is the kind of difference about macro versus a lot of other things. When someone's sitting there and just trying to pick a good stock, the macro could matter. But the reality is that what's more important is the specifics about that stock, the accounting, the balance sheet, all those sorts of kind of specific to that company details. Whereas when you're trading these kind of big general products, you need to understand what oil's doing and what it might do for you to understand what bonds will do, or what, stock market will do. And they all kind of work together you need to kind of have a narrative for how they all work together to actually have a good trading system.
No, it's well said, and I think that's it's something that I try to explain to my readers a lot. I know sometimes I sound like a crazy. I mean, I'm sure I'm ADHD and all that, but my brain gets to other areas and I get sucked down other rabbit holes. But that also helps me to understand whatever rabbit hole I'm already currently in.
Right.
And I think that's really important. I mean, you talk to Jim Leitner a lot on your
Yeah.
show, and like, him being to me, he's one of the best at really articulating what we do and talking about, buying what does he talk about? Turkish companies, the when the earthquake happened, buying all these companies in
Yeah.
Turkey, window companies, like that's what I think real macro traders are, because I don't think we really care per se, like what exactly is the underlying thing all by itself. It's how does this all come together? What is the global events that can kind of push it one way or another? And whether you're price action based or not, like that, we all kind of fall under that similar category. So
Right.
I love that.
So Jim Leitner, by the way, is actually, not only is he a terrific trader, one of the best risk takers I've ever seen, the original thinker. He is a wonderful human being, and like I consider a real honor to have gone to know him and count him as my friend. And it's just one of these things that I'm forever grateful for being able to be introduced to him. And actually, a quick little funny story about how I got to meet him.
Please.
I actually wrote a piece way back when, and it was something I called it my Leitner moment. And it was tongue in cheek. And the reason it was my Leitner moment was Jim Leitner wrote a piece in, or sorry, no, he recounted it in the book Inside the House of Money by Steve Drobny. And he recounted how he was worried about interest rates going negative. And I know now everyone's like, oh, of course they can go negative. But back then, nobody had ever thought about this. And all of the people that were like, he was buying zero or he was buying Eurodollar calls. I think it struck at 100. And all of Wall Street was like, you're insane. Like, this is nuts. Like, you're just absolutely nuts. We'll sell them to you for like nothing. And he was buying them. And it was because he understood that the world could be much different than people imagined. And so anyway, so I wrote this piece and it was called my Leitner moment. And somebody sent it to him. And he was like, and they were like, and he reached out and he said, oh, it's been a long time since anyone's talked about me or something like that. So I appreciate it. My wife was very, very impressed that someone had remembered that I wrote this piece and stuff like that. And since then we've had a friendship. And as I say, he's just one of the nicest, kindest gentlemen around.
No, I love that. And your conversations between you two, and I would advise everybody to check that out. I mean, they're really good conversations, and you can tell you guys are friends,
Yeah.
and also vibing off of each other's ideas. I mean, that's really it's really important in this industry to be able to do that with somebody. So another great question, because I've been talking like crazy about Leitner in the last few weeks. So have what do you think is the biggest lesson that we all get from James Leitner? What's the lesson from the book Inside the House of Money, your interviews? What's the big overall theme?
Okay, well, I'll
you
tell
can
you
think of?
for me specifically what I learned that I had not appreciated. And so I grew up on an equity derivative desk. And if you think about equity derivatives like this, like we're trading, although it was the Canadian equity derivatives, we were trading options and they were short dated options. And in general, the volatility risk premium is positive for index, meaning that the implied volatility of the options is higher than the realized volatility. So you can make money in general over the long period of time being short and then delta hedging those options. Being a bank with a bank's balance sheet, being a dealer that's seen all the flows, it made sense for us to always be short volatility. And sure enough, like we made a ton of money doing it. Of course, we had, some ugly moments during long-term capital and stuff like that. But the good thing was we were a bank. We could just kind of sell a little bit more and keep going. So for me, I've never traded options from the long side. I've hated long side options. Like I've never been a good long side option trader, because also don't forget, I'm not a single stock trader. Like I'm a macro trader. So generally, like the times that you're making a lot of money on on options, being long options, is when things move hard and keep going. And given that the volatility risk premium is so high in index options, it didn't ever make sense for me to be long. So I'm almost never long in, volatility on the indexes. But one of the things that Jim taught me, and it wasn't just Jim, but Jim was the one who really kind of solidified it for me, was his use of long-term options to get leverage for him to be able to stick with a position for a long time, and for him not to have to worry about the timing being perfect. And so what do I mean by that? Like Jim would go, and if he got bullish on something, he would go buy like 1 year, 2 year, 3 year options, and he would hold those. And the nice thing about those is when they're so long, the theta, I mean the decay that upon which it's very minimal, because the reality is that the theta increases as you get closer to expiry. So one of the things that I came to realize after talking to him and watching these things is that he used long-term options way, way more than I ever imagined. Like it was eye-opening for me. And there was a couple of other individuals that I interviewed that also kind of had been very successful in life, and they done the same strategy. And that was kind of an eye-opening moment for me, because up until then I'd always done what they call Delta One. So if I got bullish, I went and bought the S&P. If I got bearish, I sold it. And I still do a lot of that. But there's times when I think when I'm trying to play something bigger, I'm not exactly sure when the timing is. It is a long time, long position. And I'm thinking that it's going to take a while to unfold. I'm not sure if it's going to happen this week, next week, maybe next month. And I'll buy 1 year, 2 year call options. And so that was kind of the really thing that helped me understand is Jim and his use of those options. And like, it ended up being like his portfolio would be basically stuffed full of these things. Like that would be his entire exposure. And it's a great way to think about it as well, because he's in essence also like all of his money management that you have to worry about if there's all of a sudden some horrible event, it all takes care of itself, because it's all your deltas are going to get smaller as you moves away from your strikes.
I mean, to me, that was one of the biggest things I learned from him as well, which is that whole idea is amazing. And I talk about this all the time, and I hope people are listening to this, because it's a thing that happens so much with new traders. New traders love to buy. I don't even want to say this, but it's like zero DTEs is the new thing. It's a new thing. Everybody's interested. I thought it was crazy when people would buy 30-day options. Now they're buying, trying to single day expiries. Like, I mean, it's crazy. You would have never thought you would see that before, but now that's happening. That's kind of common. But yeah, so that's really interesting. I like that idea, because you can play that out in so many different ways. I mean, the one time he's on your show, he's talking about the idea of uranium, when it was pretty cheap, when the uranium miners were pretty cheap, and buying some calls in that. I mean, he has all of these great ideas on there. So definitely check those out. Definitely read the book too, Inside the House of Money. That's a great book.
For sure.
So getting on to the next part, which is I wanted to talk to you about bonds a little bit.
Okay.
I was just reading your whole thing on bonds that you just posted. I think that was last night. And you had a couple different viewpoints on bonds that are different than most of the street at the moment. So what are you thinking about bonds? And just kind of lay out a little bit of your thesis, and then we'll kind of go back and forth on it.
Okay. So first of all, I mentioned earlier my views about MMT. And people think, oh, you're an MMT, or you're foolish, you don't understand anything. And I always used to say, well, no, I understand MMT. I understand that this is going to be a tendency. I also understand that it'll get abused. Like if you go and you let people start spending money, they're going to spend too much. And ultimately, I was actually a big inflation guy way back when. Like I've been an inflation person for a while. And I know it seems kind of quaint now, but if you think back to pre-COVID, it was pretty well assumed that you couldn't have inflation. Like you would literally, I would have very senior hedge fund managers tell me that there was no way we could possibly have inflation. And they said the 3 Ds. This is what they always said to me. And it was debt, meaning the large amount of debt in the system, demographics, meaning the fact that we're aging, and then disinflation from technology, meaning like the fact that there's all these computers. And I said, okay, I agree with you that those are forces that push down inflation. But I always said, if you have the political will, you can create inflation whenever you want. And I've been saying this for a long time, and it really took until COVID for them to actually change the way that they focused on the system. And what do I mean by that? They moved from being purely trying to stimulate the economy through a monetary basis to actually using some fiscal. And at that point, inflation came and reared its ugly head. And so I was very, very bearish on bonds in 2022. And I wrote this piece, and it was a Bloomberg opinion piece. And I kind of laugh about it because when I wrote it, it was basically saying that the bond market might be in for some troubles ahead. And what was interesting about it was that I ended up getting all sorts of emails from very senior bond managers throughout the world telling me I don't know what I'm talking about. The reality is that the bond market is going to teach me a lesson. There's no way that bonds are going above 2%, yada, yada, yada. So I've been very bearish on bonds for a while, just to kind of set the stage. In the last little while, I haven't bothered being bearish because there was no real reason to be bearish. In meaning that the inflation was rolling back over. We had kind of the problems. I was worried about the economy slowing down. And I was at this point where I was kind of just neutral on bonds. But recently I'm back to the bear camp. And let me tell you why. So first of all, one of the problems with the bond market is that the moment we get any sort of economic weakness, the bond market goes and prices in a bunch of cuts. So right now we have, I don't know, what is it, like 10 cuts priced for the next few rates? Let me just look here. Like it's, let me pull it up on my work screen. So right now the policy rate is 5 3/8. And so in September of 2026, we have it at 294. So it's like what is that? 200 odd, almost 250 basis points of cuts. And what that is, it means is that when you're going out and let's say you go and buy a 2-year treasury note future, and you think I'm buying the 2-year treasury note future because I'm convinced the economy is rolling over. The reality is that is already priced into this. So for you to make money, you actually need for there to be more than the current 240 basis points of cuts priced into it. That has to increase. And that's ultimately what's happened over the last few kind of months, is that we've gone from 100 basis points of cuts to 250 basis points of cuts. But I'm now at the stage where I'm looking at this and saying, okay, where is the Fed going to cut to before the economy starts to take off again? And I look at it and I say, I think that once they cut to 3%, we're going to be surprised at how quickly the economy perks back up and how much inflation comes back. And the reason I think that is because ultimately I still think there's a lot of fiscal stimulus in the pipeline. I think it's still percolating there. I think that the government's going to keep on spending. I think that there's all sorts of inflation in a lot of different ways. And I also don't think that the economy is as precariously balanced as everyone kind of claims it is. This is a much different economy than the economy of 2007. So I just don't see this kind of collapse back down to zero. So for me, I look at the 2-year, I think to myself, they're going to cut, and I'm fully accepting the economy is slowing. I'm not trying to debate that. I'm only debating what's already priced in. And I think that right now they've already priced in a move down to 3%, which I think is where the Fed will go to. So that's already priced in. And then from there, one of the things that I think a lot of people miss, and I haven't written about this yet, Jason, this will be my next piece, is you say to yourself, okay, the Fed's going to cut down to 300 basis points, like that, the 3%. Maybe I should go out and buy 10 years. Okay. But the problem is that when the Fed starts cutting, what happens is the yield curve steepens. So the yield curve is the difference between the front end and the long end. So this year, let's just take the 2s versus 10s, which is the ones a lot of people talk about. So often what will occur is that'll steepen by like 300-400 basis points from the extreme of inversion all the way to that point. So if we had a situation where the Fed cut down to 300 basis points, down to 3%, and 2 10s should really be, I don't know, let's say 200 basis points of steepness, that means the 10 years should be 5%. And if the 10-year is 5%, right now it's 4 or 380 or something like that. That means you could actually have a situation where the Fed is cutting and the long end is going down. And I know that blows people's minds because the reality is that we've all been conditioned of these last 40 years of inflation going down, interest rates going down, and we have these increasingly lower and lower rates. But if the world has changed and we've gone from a period of monetary stimulus to fiscal stimulus, and if the economy is actually going to be stronger than everyone expects, then let's face it, it has been over the last, like the last year or two, everyone's been shocked at how strong the economy is. If that continues, then what you could find is that even as the Fed cuts rates, the long end sells off, meaning goes up in yield. And that would sure put a lot of people, like that would be the biggest surprise out there for a lot of folks.
I like that thought, because if you go back to 2018, you saw it in the opposite direction. The Fed was hiking and the long end started to come down. And this does happen. People think this doesn't happen, but it does happen. It usually calls bullshit on the whole thing. And that's what you're kind of saying could possibly happen. I like that thought. I am long bonds at the moment. I'm long the 2-year, and the 10. And I like the idea of being long them, but at the same time, I've been writing the whole time that I think this is short-lived. I think we're in a structural downtrend over possibly the next 40 years. Anybody who thinks that we're going to go back to zero rates anytime soon is kind of crazy. I don't think that can possibly happen anytime soon. Once again, the markets, I could always be wrong. Everybody can be wrong. But once again, it's a very interesting thing to kind of pay attention to here, which is, I think the bond market is just doing what it's doing in the summer months. This happens a lot. The summer months, you kind of get the slowdown, you kind of get choppy markets, a lot of volatility. It's before an election. People start to run to safe havens. You see bonds and utilities. Like, it's kind of just going perfectly with that playbook. And then when we get into the fall, I believe, like you said, and I think the same thing, inflation is under the surface everywhere.
Yes,
and if anything kind of moves a certain direction, we're possibly going to see a big uptick in inflation. Like you said about natural gas, you wrote about that the other day too. We could see this kind of move up. The curves, if you're looking at commodities, the curves are set up like supply is tight, demand is high. Like, they're all set up perfectly for this move. It's just not right here, right now. And like you said, we are seeing some sort of a slowdown, but it's summer. This is kind of the normal ebb and flow of things. I would assume, let's talk about time frames a little bit. So when you're looking at something like this, are you saying like structurally, because my thought is structurally, I believe the bond market could still be in a downtrend for a very long time with small uptrends in the middle of it. Of course, bear markets have bounces. So when you're looking at this, you're kind of going very long term. You're looking at this kind of being a very structural downtrend in the bond market.
Okay, and so the question is, would I play like a counter trend rally? So
would you? Just asking your time frames.
Yeah. So for my time frame, I am long term. Like, so one of the things is I do trade short term. I don't write about it because the reality is that I'm gonna, like, short is short, and not only that, where you put your stops, how you get out, stuff like means a lot more. If I'm taking a bigger, longer term position, then that's like a slow moving affair. And it's like, this is the way I'm going to lean, and I'm going to lean this way for a while. Generally, if I have a very strong secular view on something, I will not even trade it the other way. Right. So in your case, you you think bonds are going down. You agree that that we're in a secular bear market in bonds, but you're playing a counter trend rally. I generally won't do that. Now, having said that, there are exceptions, like anything, like, of course, there's rules, and then there's the rules that are meant to be broken. And so, for example, last September, when everyone was losing their shit about like term premium, and people were lecturing me about how the term premium was going to expand, how the Fed wasn't going to be able, or the Treasury wasn't going to be able to fund itself. And like, people didn't even understand what term premium was, and they were lecturing me on it. And I was like, okay, we're now at this point where I actually can go long for a trade. And I did go long bonds. That was the one time I've been long bonds since probably 2019 or 2018 or something. It's been a long time. So generally I will only trade in the direction of my secular, beliefs. And so Dennis Gartman used to have this line. He says, in a bull market, there's three positions you can have. You can have flat, long, or really long. And I kind of think that that's a little bit that way. And one of the reasons I do this is because I know that if I'm in, let's say, for me personally, at least, if I had your position and I was thinking I was going to play for a counter trend rally, and then something went against me, I would be so worried about kind of my longer term view. I wouldn't trust myself to use proper money management and stops. Like, maybe you're much better at it. You're more disciplined. And I completely get that and I understand it. Like if you set your stops, you're very disciplined about it. You're not going to run into any troubles. But I worry about like having the mental framework to know that I'm going to do the right thing. And this is one of the things that I find that's interesting about trading. It's like when you're trading well, it's almost like you just know what to do. And it's like, you're just like, even when it's going against you, you're just like, oh, I've seen this. I know what to do. And you're feeling good. You got the right size positions. You've been dealing with risk and stuff. Everything's great. When you're trading badly, you're trading too big. You're making a mess. You're like literally selling into holes. You're chasing rips because you're not in the mental framework. And ultimately, I think that's actually really, really important. So like when someone says to me like, oh, I hear you about your bond bet. Maybe I should do it. And I go, well, you know what? Like you should think about it. You should decide if that's right for you, but you shouldn't do it because I'm doing it. Because ultimately, if it goes against you, you're not going to be in the right mental framework. Or if somebody comes to me and they say, you know what, I have this position and it's like, I'm scared about it and blah, blah, blah. And I say to them, what's going to happen if it goes against you by X? And what are you going to do? Are you going to panic? And they a lot of times they'll say to me, no, if that goes against me by X, then I'm going to get out of it. And I go, well, the reality is then like, that is like, I'll pick a number that X is very reasonable, meaning that it can happen just like in randomness. Cause like, that's the one thing I believe is that after sitting on a trading desk for a long time, people think that markets are way more efficient than they actually are. And they think that like, oh, today it's up. That means that the market's interpreting this and blah, 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 blah. And I go, maybe it also could just mean that Fidelity was buying today. And I can tell you as a guy that took the orders, I remember sitting there, and it actually was in September. And I remember this, I sat there, one of our biggest clients, the Ontario teachers, they were deciding when to buy stocks. And one week we came in and they were all coming back from school, like on holidays, and they didn't buy it that week. And then I kept phoning the trader and go, you guys going to buy it? He goes, oh, we're having meetings. And so then they goes, and then next Tuesday he comes back. He goes, okay, finally, we're going to buy it. We started buying it. For 3 days, we sent the market up. And I watched like the business TV explain why this meant this. Like they were like, investors were, feeling optimistic about blah, blah, blah. I go, no, they weren't. Like I bought almost all that stock for the guy. We pushed it around. So one of the things that I do believe is that markets are more random over the short run than anyone expects. And going back to my thing about if you're in the right frame of mind, if I say to you, Jason, do you have a position and you're feeling bad about it? And then I tell you something that's just a regular standard deviation move for 1 or 2 days. And I say, if it goes down by this amount, what are you going to do? And you go, I'm going to puke. I go, well, then your position's too big because you should assume it's going to go against you that hard. And when you're trading well, those things you'll be like, if it goes against me like that, I'm fine with it because I understand that that's what, I'm going to be in the mental frame to go, this is just noise. I can live with this.
This is why I have these conversations, and I love this part of the conversation. I know it's probably like a little bit boring to some people because it's like we're not talking picks, but this is the real stuff that makes you a trader. So to just kind of add on to that point, for me, yes, it's once my positions are on, they're systematic. I do the same thing every single time and back test my entries, exits, all that stuff.
Right.
So like it makes sense once you get a certain signal to do that. But once again, like you said, and like I think the most important thing to always pick up about traders is like you have to really understand your strategy, your plan, the way you do it. I know people who do a great job by just staying incredibly bullish the entire time they're in a bull market, and they do
Yeah.
very well at that, and they understand the turns and everything inside and out. And then I know people who can trade very short term. I'm not a short term guy by any means. I'm probably, my time frame is probably 6 months to 12 months. But there's people who can trade, in 1 month time frame. I don't know many day traders who do very well. Every time I say that, I get a bunch of people writing me very angrily. But I'm just
I
saying, I
actually
don't know
know a
many
lot.
of
It can definitely be done, folks. Do
I,
not give
I've
up.
I've seen a few of them.
Yeah,
I've seen a
I
few
know
of them.
some of them. Some of my
Yeah,
best friends make
yeah.
unbelievable livings doing it.
I'm terrible at it. So that's
Yeah,
that's the thing why I say I don't have any edge there. I know that for a fact, but I do know there's are people out there that can do it. So I'm just
yeah,
saying there's a way to do it, but there's a way to do any type of trading is
yeah.
the main point of all this. So figure out what works for you. And I like to ask people questions like that because then they can kind of see what works for you, see if that fits them, and so on. Because I know for me, when I learned how to trade, it was kind of a similar thing. Try to figure out where I fit in.
Right.
So getting to the inflation part of the thesis. So
Okay.
when are you looking for that type of a move? Are you thinking that this is when you're looking at a trade, do you even look at a time frame and go, hey, probably year end, probably something, or do you just kind of keep paying attention to the data, and as the data comes out, understand how you're going to position and so on?
So sometimes I don't like I think it's hard to time things. Like I'll go, I'm not sure when this will happen. And so a lot of for my trades, I'll sit there and go, okay, if I'm wrong, what's this going to cost me? Like how much am I going to lose? And then what am I going to win if I'm right? So for example, I hate owning VIX, like as I explained. But I started to get nervous about this thing called the dispersion trade, and I wrote about that. And I got nervous about a bunch of different things. And the other thing was I saw that I thought that the election premium would keep that VIX contract bid for a while. So I went and I didn't know when it was going to occur. I didn't know how to time it. Like I always think anyone that claims they do is just full of it because I really don't buy it. Um, some people they can jump on it. They can be ready for it. They're watching for it and they jump on it. But the reality is they're jumping on it, then they have to jump right off of it real quick. So it's difficult to do. And the other thing is that if it goes quick, you actually end up having to pay up for stuff really quickly. Like you'll get 1 or 2 days that'll just immediately it'll start to work. And if you miss it, it's hard to pay up for it. So for me, I look at a trade and I say, okay, if I'm wrong, how much is this going to cost me? What is going to be the pain? And then how much am I going to make if I'm right? And it's kind of going back to that thing about Jim Leitner when he talks about the fact that if you do it with options, you can have a lot more staying power. So although I don't always do it with options, I'm always thinking about if I'm wrong, what's it going to cost me? How much am I going to be able to sit through? What's my plan? And then I just sit around, hopefully getting to a point where I think, okay, I don't think I'm going to lose very much if I'm wrong. And if I'm right, I'm going to make a lot more. So I was very bearish in July. Like I guess it was like, and it was ripping in my face. And like there was no doubt about it. I was feeling some pain but I was prepared for it. Like I went into it and was like, okay, I don't know if it's going to be this week, next week, or next month, but I could feel that I was like, there's something bad coming. And I really did think that was the case. And I was lucky. And I was lucky also that I covered it quickly enough because I'm still shocked at how quickly we bounced. But anyways, it doesn't matter. The point is that setup in terms of thinking about, the pain versus the reward, and then thinking about like how long you can last is everything for me. So I don't sit there and go, I expect this to happen within 2 months, 2 weeks. I have a general time frame. Like if it's something I think that's going to be super long, like take a year, I'm not going to bother. So like for example, bonds, I haven't been short in a long time. And I'm just starting to put it out now. Like I'm just starting in this today actually was the first day that I started to buy some, like I actually bought some puts. Jim Leitner would be proud of me. But and so I will go and I will wait. But the point being that I'm now, because the market is now at a point where I feel like if I'm wrong, there's so much good news, quote unquote good news, but really bad news on the economy priced into those bonds, that the news for the economy is going to have to be really, really, really bad for me to lose money. So that's how I think about it.
I like that because if as a trader, it's a thing. Sometimes people are early, sometimes people are late. I have price action signals to get in and out of things. I'm usually late to everything. I'm late to the party every single time. Some people are early to the party.
So I am the early guy. I am the early guy trying to be a hero.
Yeah. But once again, everybody can do it. I've seen, it's just what you're comfortable with. I know like certain people like talk to me all the time and they're like, man, I can't believe you buy breakouts. That's your systems. Like I hate breakouts. And most people do. Yeah. It's the same way with like mean reversion or whatever type of trading strategy you run. Like somebody's going to hate it here. Somebody's going to love it here. I love that trading is set up that way where there's so many different conversations. Like you and I could have a very similar view, kind of like we do today, and be trading it so differently.
That's correct.
So I love that part about trading.
I wish I was more like you, Jason, because I understand kind of intellectually that that's actually a better strategy. Because your way, you're waiting for the market to tell you. And the problem about your way is that when you buy breakouts is that you're going to lose more than you're going to gain. But the thing is that if you do it consistently over time, the ones that work will pay for the losses. So you will have a strategy that you could have a strategy that loses 2/3 of the time, but you're getting chipped away. And then the 1/3 makes all the thing. I just have trouble doing it. And it's hard. It's mentally difficult. And like, how do you deal with it when you have, like, you bought 4 breakouts in a row and they fell right back down each time?
Oh, it's mentally difficult, that's a thing that I always will tell people. It's like, it is not for everybody. Cause I think, you'll talk to the trend follower guys and they'll be like, yeah, just so you know, this is the way. You gotta be a breakout trader. You gotta buy 100-day highs, sell 50-day lows, whatever it is. And I'm the person who will tell you, like, you gotta match it to your personality. Like,
okay, well, that's good because those trend follower guys, what they don't tell you is that you're going to lose 3/4 of your trades or something like that. It might even be higher. Like, it's crazy how much you're going to, lose those. And then I think that's a great thing about matching to your personality.
Yeah, exactly. So, I mean, they tell you those things and it's like, well, one is I also grab a macro and these guys, they talk to me and they're like, well, you're not a real trend following trader. And I'll always say, why do you think that? And they'll answer will be, you use macro signals. So I use a regime model.
Right. Okay.
And those models actually help me to get into trades a little bit better than the, 20-30% win rate. And so I think that's part of it for me, that I have a little bit of an edge. I feel like I have a little bit of an edge there. And like, let's say I learned it from Neto, actually. Neto said, you take a 40% win rate system, you add a regime model on top of it, you end up with a 60% win rate system, most likely 50. He said 60, but it's more like 50. but 50-50 with proper risk management on top of it. Like now you're able to kind of make some money. So I think there's ways of doing it, but I think no matter what, we could talk about this too. No matter what, trading is difficult.
Yeah.
Whatever type of trader you are.
One of the things that I really appreciate about you, Jason, is that you just talked about like 50-50 and like that's a great system and that's more realistic. And everyone thinks, oh, these guys that are, that are trading, they must be nailing every trade. They must make, like, Stanley Druckenmiller must make 90% of his trades are right. And the reality is he's done it. He's done the math and he's told you he's 60%. And I think I saw the SAC guy, what's his name? Steve Cohen. He figured it out. I think he was 57%. And so I always say the reality is it's, trading, like making money is easy. It's not losing it that's hard. And the reality is like how you deal with those losses and how you deal with the risk means way more than all of this other stuff. Like we sit around, we talk about like these regimes and we talk about like my fundamental macro views or whatever. But the reality is that your money management is actually probably the most important thing that you're going to like focus on. And if you don't have that, all those other things aren't going to help you at all.
Yes, and that's why risk management is so important. It's the truth of trading is that you're going to get it right half of the time if you're really good. You're gonna
Yeah.
get right a little bit less if you're even good. Like most people
Yeah.
who are good or good traders get it right about 40% of the time. And so
Right.
your risk management comes into it. But not many people like to talk about that because, once again, like we all want to think our calls are right and we all have
Yeah.
an ego to some sense. But over time, you get it beaten into, at least myself, like it's been beaten into me to just embrace that idea that you're going to be wrong a lot. Trade so your losses are so small that your one big winner pays for like 10 of them, and
Right.
then that's the best way to do it. So I continue to kind of stick to that strategy.
Yeah.
And I think it really helps. And but mentally, like, what do you do when you're going through like a losing period? Like you're just kind of getting everything wrong, and you don't feel like really in tune with the markets because you're a discretionary guy. And for me,
Yeah.
like even myself, like in a regime model, like I still have some discretion there, and there's times where I'm out of tune. So I want to know, what do you do when you're out of tune with the markets?
So that's a great question. And I struggle with this. Like, this will probably be one of my problems is that I think, oh, I'll just power through this. I'll figure this out and I'll just keep trying. And inevitably, I'm just making it worse. Um, and I do think that you go in streaks. And although, like, I joke around and talk about the market gods, and I don't really believe there's market gods, but I do believe that there's a certain kind of um, tendency. Like, if you think of yourself, like if you're overly cocky, you're gonna not follow through on the risk discipline. If you're overly confident, you're gonna trade too big and stuff like that. So when I talk about the market gods, I'm really kind of just facetiously talking about like yourself and your attitude. And so what do I do? Well, how about this? What I should do instead of what I do. Okay. What I should do is I should stop trading. And there are times when there's just not the opportunities or I'm just completely out of tune with it. I can't remember which trader said something about it in Market Wizards, but I think it was something like when I start trading badly, I reduce my position. I keep reducing my position. And so when I'm trading the worst, I'm trading the smallest. And when I'm trading better, I increase the position. So when I'm trading the best, I'm trading the largest. So I think in essence, that's the philosophy that traders should have. And like I even think back to like when we used to have errors on the desk when I worked on an institutional desk, and you like literally someone would get an error, and I would see people all of a sudden like they get an error and they're like bullish because they're long, and I'm like, well, you wouldn't buy that, so why are you like all of a sudden you like it because you're long it? Like I'm like, and I always tell people if you have an error and it's big and you're like don't want to take the loss, cut it in half. Or if you're finding yourself with a position that's too big and you can't think straight, which until you're kind of really trading and understand that, you can tell people about that. You can try to explain to people about this, but until you experience it, you don't really understand it. Cut it in half till you're thinking better. Like immediately cut it in half. And if you're still thinking badly, cut it in half again. So I just tell everyone, cut it in half, cut it in half, cut it in half. And so for me, I should just stop trading and just go do something else. And I'll leave with the one last story in terms of this question. Soros used to get this problem, and he used to go and he'd be trading and he'd be like, oh shit, it's not going well. This is way back when there was like faxes, like, and so he would literally take his entire portfolio on a Friday and fax it to Goldman Sachs, his entire portfolio, long, shorts, everything. He'd fax it to them and he said to them, give me a price on all this. They would give him a price. They'd be like, okay, it's like, 100 million bucks or whatever. They would send him the 100 million bucks. They take all the positions, and then he would start and build the position back, build everything back on Monday. And you'd be surprised. I can't tell you the number of people that I know that have gone and like they'll have bought a stock, it'll gone against them, but they'll still think they like it. They'll go and they'll end up, trading it around. And all of a sudden they've been lugging this thing around for 6 months or whatever it is. And then they'll be like, I got to just get out of this. They get out of it and they're like, I'm going to get out of it for a little bit and I'll just buy it back a week later. And they don't buy it back. And the reality is they don't buy it back because once the position's off the sheets, they realize it's a crap position. And so ultimately what you need to do when you're trading badly is trade smaller to the point where you might not even be trading at all, reset, and then come back and, with a better frame of mind.
Yeah, and I'm one of the only system guys who will tell you, like, I stopped trading too, you know, and people will say if you backtest the system and you stop trading, it will tell you like you lose money this way and so on. But I personally believe like your brain, your mental health, like can get so foggy, and you're still the person who has to click the damn button. So at the
Yeah.
end of the, so at the end of the day, like you know, you have the idea, and I've everybody in the world who's ran a system, I don't care who it is, has done it wrong at some point.
Yeah.
And so you're going to do it wrong. You're going to try to get in too early. You're going to get in too late, like whatever it is. Like, so you got to be in tune with the market. So I like what you said there. I think that's interesting. And cutting your position sizing down. I tell people this all the time is like, if you feel like you're trading badly or you're like up all night, you know, you're going to bed, you're worried about your positions or something, you know, get out of the damn positions.
100%. If you're thinking about it at night like that, you're too big. 100%. By the way, on your systems, I had a system that we used to do, and it was like an MOC program that we used to pull in and read the MOCs and then trade it and stuff like that. Anyways, and it was automated, and we just had rules and we went on it and stuff like that. But then there would be a big rebalance day.
Mhm.
And I used to go, oh no, I'm nervous about this. And I would go and I'd like have these things and I'd be like, I changed the system, right?
Yep.
And the kid that worked for me, I'll never forget this. He's like, you're not adding value. You're actually subtracting value. This is like negative alpha. And so we used to go and we used to like measure like me coming off the like, you know, monkeying with the system because I was quote unquote nervous or whatever. And I messed it up all the time. Like it was negative, you know, like it was negative value add. That's what we called it. Negative value add. So I get it. I understand. And because I was monkeying with it as opposed to just turning it off, which is completely different.
Yeah, I mean
Yeah.
it's tough. It's a
Yeah.
very interesting one, but like I could go on that conversation forever. So
Yeah.
I'll try to stay away from the rabbit hole on that one. But so to kind of just to end on a note that I like to end on, which is you know you let's say you meet yourself, you're just getting into trading, you're just starting to learn this stuff. What would be a lesson you would have told yourself at a younger age? So some people who are just getting into trading who are watching this can kind of grasp onto that. So what would be a lesson you could think of?
Okay. So first of all, I truly believe that computers and technology end up being really important in this business. And I got my job on an institutional equity desk because, as my boss used to tell me, there was guys better at computers, there's guys better at trading, but there was nobody that had the right mix like you did. So that was my break. And so I might be a little partial to this, but I always think when I'm looking at younger people and I'm telling them the advice to give them, I say the reality is you're going to stink at trading. You should just realize that. Like you don't know what you're doing. You haven't done it long enough. You haven't had all the errors. So you have to say like, what can I add in terms of value add on a trading desk? Like, let's say you're going to a hedge fund desk and you're there. How can I add value? And one of the things is as you get older, it gets tougher for old people to use and adopt new technology. I, for example, am trying my darndest to like start using Python and R and doing these things. And it's hard. Like it's hard for me. I don't have enough time. I get behind and then I got to relearn it and stuff like that. But if you're a young person, this stuff comes easy. It would be the easiest value add to be like, okay, you want to see what happens on unemployment days when the market gaps up 10 for up 1% and then is by lunch it's unchanged. What does the next week look like? Those are the kind of things that actually make a lot of sense for a trader to know. And it's something that a lot of seasoned traders kind of probably intuitively might know it in their mind, but to be able to actually see the stats is super helpful. So if you're a young person trying to make it in this business, and especially on the trading side, get yourself good at computers. That doesn't mean you need to be like a full-on quant. I happen to believe anyone can be good enough. And I'll give you just an example about this. I was in New York City and I just kind of reached out and said, anyone want to come? Like I was there for business and it was a night. And it says, anyone want to come? I'm midtown. Let's go for beers. And so inevitably you do like a last minute call out. You don't get guys with families. You get literally like 29-year-olds that are living in the city. So I'm sitting there, I'm like 45 at the time, and I'm like with all these 25 to 30-year-olds, and they're like, I'm having a great time. It's really nice. They're super nice people. But I remember talking to this one guy, and he really kind of I use him as an example for young people because he went to business school or whatever, and it wasn't like a great school, but it was like he went to business school. He was very regular in terms of his background, but he got this job at a hedge fund, and the hedge fund started losing some assets. And he said, I could see the writing on the wall that this wasn't going well. And I looked around and I thought to myself, like, how am I going to add value? And he looked around and he's like, holy shit, well, nobody knows how to program and this Python stuff, and nobody's doing this. And the reality is we need someone to do this. And he just put his head down and he just learned Python. And he ended up adding a ton of value. He ended up staying. It was great for him. And that's the kind of thing that a young person needs to do. And that's probably your easiest thing for a young person, is because you're also more comfortable with computers and you have more time to learn those things. So computers would be kind of the skill set I would encourage everyone to use in terms of young people with trading.
And I love that, because that's where, I kind of gravitated towards as well, which is understanding that simple fact of, one, back testing is important. It doesn't tell you the future by any means, but just something to kind of understand history of markets. I think some people like you are well versed in history like that, and you understand, like, hey, I could go back here. You could probably name things off the top of your head, but if you're a new trader,
Right.
it's something that's going to take time for you to learn. But if you can back test it and understand, even something as simple as, one of the first things I did in trading, which was pretty fun to learn, which is, hey, would this portfolio do throughout the 70s, and then back test that? How would this portfolio do in the 80s, and then back test that?
Yeah.
Hey, little things like that. You'd be surprised how applicable that is to other areas in your life, other areas outside of finance. Like,
Yeah.
it's very interesting. So I'm glad you said that, because that's the most unique answer I've gotten so far.
Oh,
So.
well, that's good. And just by the way, like the thing that everyone talks about, like outside reversals, like everyone goes, outside reversal, you got to go home short because it, opened on the high, closed on the low, and it was an outside reversal.
I know where you're going here.
And you do the math, you go test that thing. It's a terrible system. Like there's
Terrible.
absolutely no edge. And in fact, you should be buying the outside reversal. So it's those kind of things that, with a little computer, elbow grease, you can figure out, and you don't fall for the narrative of it, what everyone believes is just so.
Yes, absolutely. And if you guys want to write in, please feel free to ask me. The newsletter, I could show you guys some things here and there if you guys want. If you guys would like that, I've been doing this Breaking It Down series where I teach things. So if you guys want me to do that, please write in. All right, guys. I wanted to thank Kevin so much. Thank you for coming on. This was an absolute pleasure. What a blast to have you on here. I hope everybody enjoyed it. Please feel free to write in and let us know. And thanks, Kevin.
Thanks, Jason. It's a real pleasure meeting you.